Hi, this is Dan Collins, Editor-in-Chief of Futures Magazine for Traders Exclusive, coming to you live from the floor of the Chicago Board of Trade. Well, for months and months, we've been talking about the lack of volatility in the market and warned that volatility would return, particularly warned in our recent October issue that October is a month that typically brings volatility, and guess what? It's happened. So just to kind of review a couple of things, because the market has made a 10% move down. It's up slightly this Friday, and it'll be interesting to see what happens the rest of the day. We had put on futuresmag.com earlier this week that a big technical level was passed at the 50-week moving average in the S&P 500. You can see that on futuresmag.com. It was blown away with Wednesday's big market activity, but with the market settled well off the lows, it left a chance of perhaps an end, or at least the end of the first stage of this sell-off. And the target to look at today as we close the week is obviously somewhere between 1882, which is that 50-week moving average. As you recall, if you saw the story in 2011, it busted through there in that one bear market that hit starting in July of 2011. 2012, that level was breached twice, but came back and settled right at that point. So that's a very significant level for the remainder of the day. That is something to watch, and that's going to be somewhat of a pivot as we go forward to see is if, as we wrote recently, is the market satisfied with 10%, or is that just the first stage, and if there's further movement down to go? The other thing that I've talked to you over the last several months is to make sure that you have an allocation to alternatives. I was joking with a friend when we saw a story about CalPERS pulling out of hedge funds, which really means managed futures and all alternatives, that might be a signal of the top of the market. Lo and behold, it really was. But it's important for you, for all investors, to have an allocation to alternatives. Managed futures typically does well in poor market conditions for equities. It has done well in this very last quarter. Many experts believe that the difficulty of managed futures has had a lot to do with the risk-on, risk-off nature of markets, because the markets were moving because of quantitative easing and Fed policy. QE3 is due to come off the board this month. There is some question whether they'll delay it a little bit because of the sell-off. I don't think they will, and I don't think they should. I think we will, like it or not, see a return to normal fundamentals, and that means the Fed's not going to be sitting there to bail out this market every time it looks weak. So this sell-off, may continue or it may be over, but you're not going to have this continuous upward trend where every small pullback is just a short thing and the market makes new highs, because the Fed will not be able to continue to bail it out. I think tightening will happen in the mid-2015. That's been pushed up. But look at futuresmags.com, because we have a lot of interesting technical stuff, what we're seeing with the Fed funds since the sell-off, and particularly some of the technical levels that we're putting out. It's been Dan Collins for Traders Exclusive. See you next time.